Now we will talk about the financial management chapter 5. Uh, the heading is that capital budgeting evaluation techniques. I repeat, capital budgeting and evaluation techniques. Methods of appraisals. Investment appraisal method can be divided into two basic areas. One in which no time value of money is taken into consideration, and one in which it is using time value of money while evaluating project is known as discounting. A. Non-discounting methods. There are three methods A, B, and C. Discounting method, and economic value added EVA charm as per performance measure. Now we will talk about the non-disgusting discounting methods. What's the key point are urgency, payback period, accounting rate of return. Debt service coverage ratio. B. Discounting methods. Net present value. The key point are net present value, probability index, internal rate of return. And C you already talk about. I already talk about C. Economic value added EVA charm as a performance measure. We talk about disgusting method of appraisal. Now we will talk about non-discounting methods. So first key point is urgency. According to this criteria, project which are deemed to be more urgent get priority or project which are regarded as less urgent. The problem with this criteria is how can the degree of urgency can be determined. In certain situations, of course, it may not be difficult to identify highly urgent investment. Highly urgent investment. For example, some minor equipment may have to be replaced immediately due to failure. To ensure continuity of production, non-replacement of such equipment may mean considerable losses arising from stoppage in production. It may be fatal in such a case to go detailed analysis and delay decision. In view of this limitation of the urgency criterion, we suggest that in general it should not be used for investment decision making. In exceptional cases where genuine, genuine, genuine urgency exists, it may be used provided investment outlays are not significant. Now we will talk about another keyword, payback period. Payback period is the most widely used technique and can be defined as the number of years required to recover the cost of the investment. This is easy to calculate but is often calculated before tax. and always after accounting depreciation. By definition, the payback period ignores income beyond this period, and it can thus be seen to be more as a measure of liquidity than of profitability. The payback period is the length of time required to recover the initial cash outlay on the project. For example, if a project involves a cash outlay of rupees 6 lakhs and generates cash flows of rupees 1 lakh, rupees 1,50,000, rupees 1,50,000 and rupees 2 lakhs in the first, second, third and fourth years respectively. It it pay, payback period is 4 years because the sum of cash flows during 4 years is equal to the initial outlay. When the annual cash flow is a constant sum, the payback period is simply the initial outlay divided by the annual cash flow. When the when the annual cash flow is a constant sum, the payback period is simply the initial outlay divided by the annual cash flow income, cash inflow. For example, a project which has an initial cash outlay of rupees 10 lakhs and constant annual cash flow of rupees 3 lakhs has a payback period of rupees 10 lakh by 3 lakhs is equal to 3.1 per 3 year. 3.1 by 3. According to according to payback criteria, the shorter the payback period, the more desirable the project. Firms using this criterion generally specify the maximum acceptable payback period. If this is n years, projects with a payback period of n years or less are deemed worthwhile, and projects with payback period exceeding in years are considered unworthy. Projects with long payback period are characteristically those involved in long-range planning and which determine a firm's future. However, they are not yield their highest return for highest return for a number of years, and the result is that the payback method is biased against the very investment that are most important to long-term success. Evolution, a wide now we will talk about evolution, a widely used investment criterion. The payback period seems to offer the following advantages. It is simple both in concept and application. It does not use complex concept and tedious calculation and has few hidden assumptions. Since it emphasizes earlier cash inflows, it may be a sensible criterion when the firm is present with problem in liquidity. It's a rough and ready method for dealing with risk in in favors in favors projects which generate substantial cash inflows in earlier years and discriminates against projects which bring substantial cash inflows in later years but not in earlier years. Now, if risk tends to increase with futurity in general, this may be true. The playback criterion may be helpful in weeding out risky projects. It's a simple both in concept and application. It does not use complex concept and tedious calculation and has few hidden assumptions. The limitation of the payback criteria, however, are very serious. It fails to it fails to consider the time value of money. Cash inflows in the payback calculation are simply added without suitable discounting. This violates the most basic principle of financial analysis, which stipulates that cash flows occurring at different points of time can be added or subtracted only after suitable compounding or discounting. It ignores cash flows beyond the payback period. This leads to discrimination against projects which generate substantial cash inflows in later years. To illustrate, consider the cash inflows of two projects A and B. Year 0, 1, 2, 3, 4, 5, 6, 7. Cash flows of A, cash flows of B. You can see here a graph or for year 0 cash flow of uh, cash flows of A is minus 1 lakhs. The payback criteria of A prefer, prefers A, which has a payback period of 3 years. In comparison to B, which has a payback period of 4 years, even though B has very substantial cash flows in year 5 and 6. Since the payback period is measure of projects capital recovery, it may divert attention from profitability. Payback as harshly but not unfairly. Fairly, fairly been described as the fish bait test in effective. It concentrates on the recovery of bait, the capital outlay, paying not attention to the size of the fish, the ultimate probability, if any. So it measures a project's liquidity. It does not indicate the liquidity position of the firm as a whole, which is more important. Accounting rate of return. The account rate of return, also referred to as average rate of return or the simple rate, is a measure of probability which relates income to investment, both investment in accounting terms. Since income and investment can be measured variously, there can be a very large number of measures for accounting rate of return. The measures that are employed commonly in practice are A by average by average income after tax upon initial investment. B B B by average income after tax average upon average investment. C oblings. Average income after tax but before interest upon initial investment. D by by average income after tax but before interest upon average investment. E is equal to average income before income and taxes upon initial investment. F is equal to average income before and income average income before income and taxes upon average investment. G is equal to total income G is equal to total income after tax but before depreciation minus initial investment upon 2 multiply by all multiply by years. This method is superior to the payback period. This method is superior to the payback period. But is fundamentally unsound. While it does take account of the earning or the entire economic life of a project, it fails to take decision of the time value of money. This weakness is made worse by the failure to specify adequately to the relative attractiveness of alternative proposals. It's biased against a short term project in the same way that payback is biased against longer term ones. This method is superior to the payback period, but it fundamentally unsound. While it does take account of the earning earnings or the entire economic life of a project. It fails to take account of a time value of money. This weakness is made worse by the failure to specify adequately relative attractiveness of alternative proposals. This weakness is made worse by the failure of to specify adequate to relative attractiveness of alternative proposals. It is biased against a short-term project in the same way that payback is biased against the longest term ones. Evolution traditionally as a popular investment appraisal criterion, The accounting rate of return has the following virtues. It is simple to calculate. It is based on accounting information which is readily available for and familiar to businessmen. It considers benefits over the entire life of the project. Since, since it is based on accounting measures, account measures which can be readily obtained from the finance accounting system of the firm. It facilitates auditing of capital expenditure. Oh, kam. While income data for the entire life of entire life of the project is normally required for calculating the accounting rate of return, one can make do even if the income date is not available. For example, when you to enter in indeterminacy of project life, a complete forecast of income cannot be obtained. The accounting rate of return can be calculated on the basis of income for some typical year or income for the first 3 to 5 years. The shortcomings of the accounting rate of returns criteria seem to be considerable. It is based upon accounting profit, not on cash flow. It does not take into account of the time value of money. To illustrate this point, consider two place investment proposal Y and X. Each requires an outlay of rupees 1 lakh. Both the proposals have an expected life of 4 years, after which their value would be nil. There are two proposals, two graphs, proposal X, proposal Y. You can see there both. Both the proposals with an accounting rate of return measure A of 50% look alike from the accounting rate of return point of view. For project X, because it provides benefits earlier, it much more desirable, while the payback period criterion gives no weight to more distant benefits. The accounting rate of return criteria seems to give them too much weight. There are, as we seen, numerous measures of accounting rate of return. This can create controversy, confusion, and more confusion and problems in interpretation. Accounting income. Accounting income. Whatever particular measure of income we choose is not uniquely defined because it's influenced by methods of depreciation, inventory valuation, and allocation of certain costs. Working with the same basic accounting data, different accountants are likely to produce different income figures. A similar problem, though, though less severe, exists with respect to investment. The argument that is accounting rate of return measure facilities post auditing of capital expenditure is not very valid. The financial accounting system of a firm is designed to report events with respect to accounting period and for profit centers, but not for individual investment. Debt service coverage ratio. Financial institutions which provide the bulk of long-term finance for industrial projects evaluate the financial viability of project primarily in terms of internal rate of return on the debt service coverage ratio. DSCR is equal to sigma n raised to I is equal to 1 in counts PATI plus DI plus II upon sigma n raised to I is equal to 1 I II plus LTII. Debt service coverage ratio DSCR is defined as where PATI is equal to profit after tax for year I. DI is equal to depreciation for year year I. II is equal to interest on long-term loans of financial institutions for year I. LRII is equal to loan repayment installment of year I. N is equal to period over which the loan has been repaid. Looking at the debt service coverage ratio, we find the numerator consists of a mixture of post-tax and pre-tax figure. Profit after tax is a post-tax figure and pre-tax figures means loans, repayment, installation is a post-tax figures and interest is a pre-tax figures. Oh, it is difficult to interpret a ratio which is based on mixture of post-tax and pre-tax figure. In view of this difficulty, we suggest two alternatives. Alternative 1. Alternative 1 is equal to DSCR, earning before depreciation interest in taxes upon interest plus loan repayment installment upon 1 minus tax rate. Alternative T is equal to alternative 2. DSCR is equal to profit after tax plus depreciation upon loan repayment installment. While alternative 1 is based on pre-tax figure, alternative 2 is based on post-tax figure. There is one more difference. Alternative 1 assumes that the interest and loan repayment obligation are of the same order and focused on the ability of the firm to meet these obligations jointly. Alternative 2 assumes that the interest burden is of a higher priority and focuses on ability of the firm to meet the principal repayment obligation once the interest obligation is fully met. This traditional method of investment appraisals are misleading to a dangerous extent. A means of measuring cash that allows for the importance of time is needed. This is provided by the discounting method of appraisal, of which there are basically two methods, both of which meet the objections to the pay, payback period is the average rate of return methods. Now we will talk about the discounting methods of appraisal. The key point is that net present value. The net present value of a project is equal to the sum of present value of all the cash flows associated with the project. One of the most important concepts originating from the time value of money NPV is calculated by subtracting the present value of cash outflow investment from the present value of the cash inflow income. Suppose you are making an investment of rupees 1 lakh today and are expecting that you will get rupees 1.1 lakhs on 1 year from now. You will only invest if the present value of 1.1 lakh is that you are getting 1 year hence is more than the rupees 1 lakh you have invested today. Using the table for present value of rupees 1 lakh with 0.909 we get approximate 1 lakh rupees 1 lakhs. That we are this means that we are getting a return of 10% from the project. If you again look at the same table, the value gets lowered as the interest rate increases, which means that for an interest rate more than 10%, we will be getting a present value which will be lower than the investment we are making. So if we are expecting a return of 15% for 1 year, we will not invest at the present value of 1.1 lakhs at 15% discount rate is lower than the investment of rupees 1 lakh we are making today. The formula for calculating the NPV is where NPV is equal to net present value. CF1 is equal to cash flow occurring at the year of end of year. C0 is equal to initial cash outflow or investment. T is equal to 0 tick up to n. Cash flow has a positive sign, whereas a cash outflow has a negative. The cash inflow has a positive sign, whereas cash flow outflow has a negative sign. N is equal to life of the project. K is equal to cost of capital. Use there is a discount rate. Here C0 is the initial investment we are making into the project, and the rest is the present value of cash flows we are expecting in the future. So NPV is the difference between the two at the expected rate of return. Mm. So NPV is different between the two at the expected rate of return. With NPV is acceptance rule is NPV greater than 0, accept is greater than 0, accept 0 indifferent rather than less than 0 reject. If the NPV is greater than 0, we accept that project because we are getting a rate of return which exceeds our desired rate of return. If it is equal to 0, we know we may or may not accept the project as well as we are getting a return which is exactly equal to our desired rate of return. And and if if it is less than 0, we reject the if the NPV is greater than 0, we accept the project because we are getting a rate of return which exceeds our desired rate of return. So now we will talk about the features of net present value. Two features of the net present value methods to be emphasized. First one is the NPV method is based on the assumption that the intermediate cash inflows cash inflow of the project is reinvested at the rate of return equal to the firm's cost capital. The NPV of a simple project mono, monotonically nically, nically, monotonically decreases as the discount rate increases. The decrease in NPV, however, is at decreasing. It is at a decreasing rate. Evaluation. Whether evaluation. Conceptually sound, the net present value criterion has considerable merits. It takes into account the time or value of money. It considers the cash flow stream in its entirety. It square neatly with the financial objective of maximization of wealth of stockholder. The net present value The net present value represents the contribution of the wealth of stockholders. Now we will talk about the features of net present value. Now we will talk about features of net present value. Two features of the net present value method to be emphasized. The first one is the NPV method is based on the assumption that the intermediate cash inflows of the project is reinvested at a rate of return equal to the firm's cost of capital. Second is the, the NPV of a simple project monocritically decrease as the discount rates increase. The decrease in NPV, however, it is a decreasing rate. What is the there? Its evolution. Concept, conceptual, conceptually sound. The net present value criterion has considerable merits. It takes into account the time value of money. Is consider the cash flow stream in its entirely entirety. It squares serenity with the financial objective of maximization of the wealth of stockholder. The net present value represents the contribution to the wealth of stockholders. The net present value of various projects measured as they are in today's rupees can be added. For example, the present value of package consisting of two projects A and B will simply be the sum of the net present value of this project individually. NPV multiplied by A plus B is equal to NPV A plus NPV B. The additivity property of net present value ensures that a poor project, one which has a negative net present value, will not be accepted just because it's combined with a good project which has a positive net present value. The limitation of the net present value criteria are the ranking of project on the net present value dimension is influenced by the discount rate. To, to illustrate, consider two mutually exclusive projects A and B, which have the following cash inflow streams. Here A and B, right? For year 0 it's minus 3000 3 lakhs, and for B it's the same as well. For year 1 it's for A, for section A it's 16,000, for B it's 1 lakh 30,000. Tick tick tick, you can see the dot dot dot. The net present value of A and B for various rate of discount is given below. Looking at the behavior of net present value, we find that first one is to find is that when the discount rate is 12%, the net present value of A is greater than the net present value of B. And second one is when the discount rate is 40%, the net present value of B is greater than the net present value of A. The net present value measures an absolute measure does not appear very meaningful to businessmen who wants to think in terms of rate of return measures. Now we will talk about another topic. It's score is as the probability index. What's probability index? PI. Probability index relates the present value of benefits to the initial investment. Profitability index related the present value of benefits to the initial investment. It's also known as benefit cost ratio BCR. PI is equal to PVC is equal to PV is equal to PVCF upon I, where PI is equal to probability index, PVB is equal to present value of cash flow, I is equal to initial investment. To illustrate the calculation of these measures, let us consider a project which is being evaluated by a firm that has a cost of capital of 12%. There are two uh, segments. First one is initial investment and other one is rupees 1 lakh. For year 1 it's 25,000. For 2 it's been 40,000. For year 3 it will be 40,000, and for year 4 it will be 50,000. The probability index for this project is PI is equal to 15,000 25,000 upon 1.12 plus whole plus 40,000 upon 1.12 multiply by 2 plus 40,000 upon 1.12 1.12 multiply by 3 plus 50 50,000 upon 1.12 multiply by 4. This uh, whole upon 1 lakhs is equal to 1.1145. With PI, the acceptance rule is PI is greater than 1 except PI is equal to 1 indifferent pi less than 1 to reject. If pi is greater than 1, we accept the project because we are getting a rate of return which exceeds our desired rate of return. If, if it's equal to 1, we may or we may not accept the project as we are getting the return which is exactly equal to our desired rate of return. If it is less than 1, we reject the project proposal because the rate of return we are getting is less than our desired rate of return. What is the evolution of this one? The proponents of probability index argue that since this criteria, since that since this criterion measures net present value per rupees of outlay, it can discriminate better between large and small investment and hence is preferred to the net present value creation. How valid is this argument? Theoretically, it can be very easily verified that under con- uncontested conditions, the pi criteria will accept and reject the same profit project as, as the net present value criteria. When the capital budget is limited in the current period, the benefit cost ratio criteria may rank projects correctly in the order of decreasingly efficient use of capital. However, its or use is not recommended because it provides no means for aggregating several smaller projects into a package that can be compared with a large product project. When cash outflow occurs beyond the Current period. Pi criteria is unsuitable as a selection criteria. Now we will talk about another topic, internal rate of return. When the present value of cash inflows are exactly equals to the present value cash outflows, we are getting a rate of return which is equal to a discounting rate. In this case, the ratio of return we are getting in the actual return on the project. This rate is called IRR. NPV is equal to sigma n raised to I is equal to 1 CFT upon 1 plus K whole square T minus C0. Using the same formula as given in the NPV above, IRR will be the return when the NPV is equal to 0 as only equal to 0 is only then the present value of cash flow inflow will be equal to the present value of the cash outflow. NPV is equal to sigma n raised to I is equal to 1 CFT upon 1 plus R raised to T minus C0 is equal to 0. So the equation is that sigma um, sigma n raised to I is equal to 1 CFT upon 1 plus R raised to T is equal to C0. Here CFT is equal to cash flow at the end of year T. R is equal to discount rate. N is equal to life of the project. In the net present value calculation, we assume that the discount rate is called as the cost of capital is known and determine the net present value of the project. In the internal rate of return, in the internal rate of return calculation, we set the net present value equal to 0 and determine the discount rate internal rate of return which satisfies this condition. Both the discounting methods NPV and IRR relates the estimates of the annual cash outlays on the investment to the annual net of tax cash receipt generated by the investment. As a general rule, the net of tax cash flow will be composed of revenue less taxes plus depreciation. Since discounting techniques automatically allow for the recovery of the capital outlay in computing time adjusted rates of return, it follows that depreciation provisions implicitly implicitly form part of the cash flow inflow. Internal rate of return method consists of finding that rate of discount that reduce the present value of cash flow, both inflow and outflow attributable to an investment project to zero. In other words, this true rate is that which exactly equalizes the net cash proceeds over a project's life with the initial investment outlay. If the IRR exceeds the financial standard, means cost of capital, then the is uh, project is uh, primiface acceptance acceptable instead of being computed on the basic basis of the average or initial investment. The IRR is based on the funds in use of period to period. The actual calculation of the rate is a hit and miss exercise because the rate is unknown at the outset. But tables of present value are available to aid the analyst. These tables should show the present value of future sums at various rates of discount and are prepared for both single sums and recurring annual payments. What does IRR mean? There are two possible economic interpreta- interpretations of internal rate of return. Internal rate of return represent the rate of return on the uncovered investment balance in the project. Internal rate of return is the rate of return earned on initial investment made in the project. What is the evaluation is that? Evaluation, a popular discounted cash flow method. The internal rate of return criteria has several virtues. It takes into account the time value of money. It considers the cash flow stream in its entirety. It makes sense to businessmen who want to think in terms of rate of return and finds an absolute quantity like net present value somewhat difficult to work with. The internal rate of return criteria, however, has its own limitations. It may not be uniquely defined if the cash flow stream of a project has more than one change in sign. There is a possibility that there are multiple rates of return. The internal rate of return figure cannot distinguish between lending and borrowing, and hence a high internal rate of return not necessarily be a desirable feature. The internal rate of return criteria can be misleading when choosing between mutually exclusive projects that have substantially different outlays. Consider P project Consider project P and Q. Cash outflow period 0 1. Internal rate of return net present value assuming K is equal to 12%. Both the projects are good, but Q with its higher net present value contributes more to the wealth of the stockholders. Yet, yet from an internal rate of return point of view, P looks better than Q. Hence, the internal rate of return criterion seems unsuitable for ranking projects of different on of different scale. Comparison of discounting methods. In ordinary circumstances, the two discounting approaches will result in identical investment investment decisions. However, there are differences between them that can result in conflicting answers in terms of ranking projects according to their profitability. The go. Informal accept or reject decisions. Both methods lead to the same decision. Since all projects having a yield in excess of the cost of capital will also have a positive net present value. Project the, the example project A and B both requires an outlay of rupees 1000. Now to obtain a return of rupees 1150 as the end of year 1 in the case of A and 1405 at the end of year 3 in the case of B. The cost of capital is 8%. cost of capital is 8%. Internal rate of return is A is equal to 15%, B is equal to 12%. Net present value B is equal to 141405 multiplied by 0.794 minus 1000 is equal to rupees 155. A is equal to 1150 multiplied by 0.926 minus 1000 is equal to rupees 65. Both projects have rates of return in excess of 8% and positive net present value, but on the basis of internal rate of return method, project A is superior, while on the basis of the net present value method, project B is superior. Confuse arises because of the project have different length of the life, and if only one of the project is to be undertaken. The, the, the internal rate of return can be seen to be unable to discriminate satisfactorily between them. As with any rate of return, there is no indication of either the amount of capital involved or the duration of the investment. The choice must be made either on the basis of net present value or on the return of incremental investment between projects. The two methods make different implicit assumptions about the reinvesting of funds received from project, particularly during the gaps between the end of one and the end of another. The net present value approach assumes that cash received can be reinvested at the company's cost of capital, thereby giving a bias in favor long-lived projects In contrast, the internal rate of return approach assumes that cash receipts are reinvested at the same rate, giving a bias in favor of short-lived projects. It follows that the comparison of alternatives by either method must be made over a common time period, with explicit assumption being made about what happens to funds between their receipt and the common in terminal date. Now we will talk about another topic, capital rationing. Capital capital rationing. In terms of financing investment projects, three essential questions must be asked. The first question is that how much money is the unavailable for investment. The second question is how are funds to be assigned when the acceptable proposal required more money than is available. How much money is needed for capital expenditure in the forthcoming planning period? The first and third questions are resolved by reference to the discounted return on the various proposals. Since it will be known which are acceptable and which order of preference. And the second question is answered by a reference to the capital budget. The level of this budget will tend to depend on the quality of investment proposals submitted to top management. In addition, it will also tend to depend on top management philosophy towards capital spending. Example, it's a growth minded or cautious. cautious. The, out, the outlook for future investment opportunity that may be unavailable if extensive current commitments are undertaken. The fund provided by current operation and the feasibility of acquiring additional capital through borrowing or equity issues. It's not always necessary, of course, to limit the spending on projects to internally generated funds. Theoretically, projects should be undertaken to the point where the return is just equal to the cost of financing these projects. If safety and the maintaining of, say, family control are considered to be more important than additional profits, there may be a marked unwillingness to engage in external financing, and hence a limit will be placed on the amount available for investment. Even though a firm may wish to raise external finance for its investment program, there are many reasons why it may be unable to do this. Examples include the firm's past record and its present capital structure may make it impossible or extremely costly to raise additional debt capital. The firm record may it make it impossible to raise new equity capital because of low yield or even no yield. Covenants in existing loan agreements may restrict future borrowing. Furthermore, in typical company, one would expect capital rationing to be largely self-imposed. Each major project should be followed up to ensure that it conforms to the condition on which it was accepted, as well as being subject to cost control procedures. Inflation and capital budgeting. Now we will talk about another topic, inflation and capital budgeting. One of the major mistakes is improper treatment of inflation in capital budgeting decision. The capital budgeting results would be unrealistic if the impact of inflation inflation is not correctly factored in the analysis, as the cash flow estimates will not reflect the real purchasing power. In other words, cash flows would be shown at inflated sums, and to that extent cause cause distortions in capital budgeting decision. Therefore, cash flows should be adjusted to accommodate the, the inflation factor so that the capital budgeting decision reflect the true picture. This section dwell on the procedure for adjusting data for inflation. Consider example 2.2. An investment proposal P requires an initial capital outlay of rupees 2 lakhs with no salvage value and will be disputed on a straight line basis for tax purposes. The earning before depreciation and taxes during its 5 year life are so we will talk about the example 2.2. The corporate tax rate is 35% and the company evaluates its investment projects at 12% cost of capital. Advise the company whether the project should be accepted when there is no inflation. Second one is when there is inflation at the rate of 15% annual. Annual. And the gross earnings are also expected to grow at this rate of inflation. The solution is that determination of NPV, no inflation situation, almost in rupees thousand. You can see here figure here. Here PBT, there are lots of sections. Here 1, 2, 3, 5, 4. PBT 70, depreciation 200 by 5, taxable income, profit after tax, in, including INC X is.x0.65. Cash flow after tax PAT plus debt, PV factor, present value. Since the net present value is positive, since the net present value is positive, the project is worth accepting. In non-inflationary scenario. In an inflationary situation, PBDT are expected to grow at 50%. PBDT can be determined reflecting 50% compound rate of growth using the table. As amount of depreciation remain unchanged, taxable profit as well as taxes would go up as exhibited below. You can see here also your PBDT compounding factor at 0.15 revised PBDT x dot x dot x dot com dot fac depreciation taxable income PAT and CFAT यानी कि C means CFAT. Since CFAT is inflated sum, they are to be reflected at the rate of inflation 15%. To determine real cash flow, the relevant calculations are as follows. Determination of real cash flows. Here CFAT discount by deflected factor at 0.15. Real cash inflows CFAT. The real cash flows are substantially lower than nominal cash flows. This is due to the fact that increased income, as depreciation charges do not change, is subject to higher amount of taxes. The corporate tax is more than twice 35%. The inflation rate 50%. The NPV and real cash inflows are shown in the following table. NPV calculation, all amount here included, all amount is in thousand rupees. Here real CF PV factor at 12% present value. Since the NPV is negative under inflationary situation, the investment proposal is not acceptable. Thus, inflation result both in lower cash flows and lower real rates of return. Example 2.2 highlights that firm, conscious of protecting the real purchase power of their owner, may go for unprofitable investment project affecting the shareholders' wealth adversely. It underlines the significance of incorporation the inflation factor in evaluating capital budgeting decisions, in particular for business firms interested in real returns. Consistency warrants that the real cost of capital should be used to discount real cash inflows after taxes and nominal cost of capital should be employed for nominal CFAT. This point is illustrated in example 2.3. The investment data of Rajiv Company Limited launching a new product and with 12% cost of capital is as follows. Particular investment CFAT year 1, 2, 3, 4, 5. The amount you can see here. You can screenshot this one so you can understand it later. We will talk about example 2.3 now, right? Assuming an inflation rate of 5%, determine NPV of the project by using both the nominal rate of discount and the real rate of discount. What is the solution? The solution is that the NPV using nominal rate of discount. Here consider another graph. Here there are four sections. Here say at in rupees, PV factor at 0.12 and total PV in rupees. After five rows, there we can see something written is that good present value less cash outflows net present value. The nominal rate of discount N is obtained by compounding the real rate R and inflation rate I in in equations terms. It's 1 plus n is equal to 1 plus R plus 1 plus I. 1 plus R is equal to 1 plus n plus 1 plus I, or the substituting the values 1 plus R is equal to 1.12 upon 1.05 is equal to 1.0667. R is equal to 0.0667 or 6.67%, or it's a table 5.2. Please note that real cash flows discounted at the real discount rate yield an identical amount of NPV that is obtained by discounting nominal cash flows by the nominal discount rate. When estimate of CFAT and cost of capital include inflation, they are said to be expressed in nominal terms. When such estimates exclude the impact of inflation, they are said to be shown in real terms. For correct analysis, these estimates should either be started in nominal or real terms. It implies that capital budgeting decisions should either reckon the inflation factors in CFAT as well as the cost of capital or exclude it completely. Hello friends, welcome back to my new video, and now we will talk about the financial management chapter 6, uh, capital budgeting under risk and uncertainties. Capital budgeting under risk and uncertainties. So risk is used to describe the type of situation in which there are number of possible state of nature, hence outcome, but in which the decision maker can reasonably assess the probability of occurrence of is. Thus, risk can be expressed in quantitative, quantitative terms. Under condition of uncertainty, in contrast, in contrast, it is recognized that several outcomes are possible, but the decision maker is unable to attach probability to the various states of nature. The liability is usually due to a lack of data on which to base a probability estimate. For instance, in launching a new product, the marketing manager may have an idea of what the sales in year one are likely to be, but he must accept that the actual level will be of the very possible levels. However, the marketing manager may be unable to specify the probability of each level being achieved, making it an uncertainty situation. There is also, of course, the situation of complete certainty. This related to a decision over which a decision maker has complete control and is thus likely to be confined to the production sphere. This is so because the existence of external agents in marketing and distribution means that knowledge is incomplete and the creative aspect of R&D means that outcomes are unknown in advance. In a, if a finance manager feels he knows exactly what his outcome of project would be and is willing to act as if no alternative were in existent, he will be presumably acting under condition of uncertainty. Thus, certainty is state of nature which arises when outcomes are known and determinate. In this state, each action is known to lead invariably to a specific outcome. For example, If one investment of rupees 20,000 in 5 years central government bonds, which is expected to yield 7% tax-free return, then the return on the investment 7% can be estimated quite precisely. This is so because we assume the government of India to be one of the most stable forces in this country. Thus, the outcome is known to have a probability of rupee of 1. Since we know since we know how things are or will be, the decision strategy is deterministic. We simply evaluate an alternative actions and select the best one. Risk involves situation in which the probabilities of an events occurring are known as these probabilities are objectively or subjectively determinable. The main attribute of risk situation is that the event is repetitive in nature and possesses a frequency distribution. It is the inability to predict with perfect knowledge the course of future events that introduces risk. As events become more predictable, risk is reduced. Conversely, as events becomes less predictable, risk is increased. Thus, if rupees 10 lakh is invested in stock of company organized to extract coal from mine, and then the probable return cannot be predicted within 100% certainty. The rate of return on above investment could vary from -100% to some extremely high figure, and because of this high variability, the project is regarded as relatively risky. Risk is the associated with the project variability. The more variable the expected future returns, from the project, the riskier the investment. In contrast, when an event is not repetitive and unique in character, yet the finance manager is not sure about probability themselves. Uncertainty, uncertainty is, is said to prevail. Uncertainty is subjective phenomenon. In such situation, no observation can be drawn from frequency distribution. We have no knowledge about the probabilities of the possible outcome. It follows that if the probabilities are completely unknown or not or or are not even meaningfully known, the expected value of any decision cannot be determined. Practically, no generally accepted method could so far be involved to deal with situation of uncertainty, while there are number of techniques to deal with risk. In view of this, the term risk is uncertainty will be used interchangeably in the following discussion. In the following discussion, with the introduction of risk, no company can remain indifferent between two investment projects with varying probability distribution as shown in figure 6.1. Although each investment inflow of rupees 5% in its 3-year life. A look at the figure 6.1 will make it crystal clear that uh, dispre- dispersion of the probability distribution of expected cash flows for proposal B is greater than that proposal A. Since the task is associated with the deviation of actual outcome from that which was expected, proposal B is the riskier investment. This is why risk factor should be given due to importance in investment analysis. source of risk. The first step in risk analysis is to uncover the major factors that contribute to the risk of investment. Four main factors that contribute to the variability of result of a particular investment are cost of project, investment of cash flows, variability of cash flows, and life of the project. Now we will talk about the size of the investment. A larger project involving greater investments uh, entails more risk than the small projects because in case of failure of the large product, the company will have to suffer considerably greater loss and it may be forced to liquidation. Furthermore, cost of a project in many cases is known in advance. There is always a chance that the actual cost will vary from the original estimate. One can never foresee exactly what the construction, design and development cost devising will be. Rather than being satisfied with a single estimate, it seems more realistic to specify a range of cost and the probability of occurrence of each value within the less confidence the less confidence the decision maker has in his estimate, the wider will be the range. Now we will talk about the second key point is reinvestment of cash flows. Whether a company should accept a project that offers a 20% return for 2 years or one that offers a 60% return for 3 years would depend upon a rate of return available for reinvesting the proceeds from the 20% 2-year periods. The danger that the company will not be able to reinvest funds as they become available is continuing risk in managing fixed asset and cash flows. Variability of cash flows. It may not be an easy job to forecast the likely return from the project. Instead of basing investment decision on a single estimate of cash flows, it would be desirable to have a range of estimates. First key point is the life of the project. Life of the project can never be determined precisely. The production manager should base the investment decision on the range of life of the project. Now we will talk about another topic, technique for handling risk and uncertainty. Technique for handling risk and uncertainty. Risk analysis is one of the most complex and slippery aspects of capital budgeting. Many different techniques have been suggested and no single technique can be deemed as best in all situations. Risk association is the event is repetitive in nature and possesses a frequency distribution. Its inability to predict with perfect knowledge the course of future event that introduces risk. As events become more predictable, risk is reduced. Conversely, as events become less predictable, risk is increased. Thus, if rupees 10 lakhs is invested in stock of company organized to extract coal from a mine, and then the probable return cannot be predicted within 100% certainty, the rate of return on the above investment could vary from -100% to some extremely high figure, and because of this high variability, the project is regarded as relatively risky. Risk is associated with project variability. The more variable in the expected future returns from the project, the riskier the investment. In contrast, when an event is not repetitive and unique in character and the finance manager is not sure about probabilities themselves, in contrast, when an event is not repetitive and unique in character and the finance manager is not sure about probability themselves, uncertainty is prevalent. Uncertainty is a subjective phenomenon. In such situations, no observation can be drawn from frequency distributions. We have no knowledge about the probabilities of the possible outcomes. Follows that if the probabilities it follows that if the probabilities are completely unknown or are not even meaningfully known, the expected value of decisions cannot be determined. Practically no generally accepted method could so far be involved to deal with situations of uncertainty, while there are number of techniques to deal with risk. In view of this, the term risk and uncertainty will be used interchangeably in following discussion. A look at the figure 6.1 will make it crystal clear that dispersion of a probability distribution of expected cash flows at proposal B is greater than that proposal A. Since the task is associated with the deviation of actual outcome from that from that which was expected, proposal B is the riskier investment. This is why risk factor should be given due important in investment analysis. Source of risk. The first step in risk analysis is to uncover the major factors that contribute to the risk of investment. For main factors, four main factors that contribute to the variability of result of a particular investment are cost of project, investment of cash flows, variability of cash flows, and life of the project. Now we'll talk about the size of the investment. A larger project involving greater investment entails more risk than the smaller small project because in case of failure of large project. Now we will talk about the size of the investment. A large project involving greater investments entails more risk than the small project because in case of failure of large project, the company will have to suffer considerably greater loss and it may be forced to liquidation. Furthermore, cost of a project in many cases is known in advance. There is always the chance that the actual cost will vary from the original estimate. One can never foresee exactly what the construction, design, and development costs will be. Rather than being satisfied, we will, we will talk about another topic one reinvested of cash flows. Whether a company should accept a project that offers a 20% return for 2 years or that offers a sole 60% return for 3 years would depend upon the rate of return available for reinvesting the proceeds from the 20%. 2 year back, 2 year period. The The danger that the company will not be able to reinvest funds as they become available is counting risk in managing fixed assets in cash flows. Variability of cash flows. It may be not easy job to forecast the likely return of project. Instead of basing investment decision on a single estimate of cash flow, it would be desirable to have range of estimates for life of the project. Life of a project can never be determined precisely. The production manager should base the investment decision on the range of the life of the project. Now we will talk about the another topic, techniques for handling risk and uncertainty. Risk analysis is one of the most complex and slippery aspects of capital budgeting. Many different techniques have been suggested, and no single technique can be deemed as best in all situations. The variety of techniques suggested to handle risk in capital budgeting fall into two broad categories. Approaches that consider a stand-alone risk of a project. Approaches that consider the risk of a project in the context of the firm or in a context of the market. Exhibit 6.2 classifies various techniques into these two broad categories. This chapter discusses different techniques of risk analysis, except market risk analysis, which is covered in the chapter on cost of capital. Explores various approaches to project selection under risk and describes risk analysis in practice. It is divided into 9 sections as follows. Hillier model, simulation analysis, break-even analysis, sensitivity analysis, corporate risk analysis, scenario analysis, decision tree analysis. Project selection under risk analysis in practice. So first of all, technique of risk analysis. The technique of risk analysis having two parts: analysis of standalone risk, analysis of contextual risk. Sensitivity analysis and scenario analysis. Break-even analysis, Hillier model. Simulation analysis, decision tree analysis. Corporate risk analysis, market risk analysis. Now we'll talk about the sensitivity analysis. Since future is uncertain, you may like to know what happens to the variability of a project when some variables like sales or investment deviates from its expected value. In other words, you would like to do sensitivity analysis, also called what if analysis, in answers questions like what happens to net present value or some other criteria of merits if sales are only 60,000 units rather than the expected 75,000 units. What happened to the net present value if the life of the project turns turns out to be 8 years rather than expected 10 years? Procedure fairly simple. Sensitivity analysis consists of the following steps. Set up the relationship between the basic underlying factors like the quantity sold, unit selling price, life of the project, etc. And net present value or some other criterion of merit. Estimate the range of variation and the most likely value of each of the basic underlying factor. Third, study of study the effect on the net present value of variation in the basic variables. Typically, one factor is varied varied at time. Illustration. What's its illustration? Anichit enterprise is analyzing an investment proposal. The following net present value relationship has been set up. NPV is equal to sigma n tends to t is equal to 1. Q p minus v minus f minus d. 1 minus t plus d upon 1 plus r raised to t plus s upon 1 plus r upon raised to n minus 1 up to 8.1. Where NPV is equal to net present value of the project. Q is equal to number of units sold annually. P is equal to selling price per unit. V is equal to variable cost of unit. D is equal to annual depreciation charge. R is equal to cost of capital. F is equal to total fixed cost including depreciation and interest. T is equal to income tax rate. S is equal to net salvage value. R is equal to cost of capital. N is equal to project life in years. I is equal to initial cost. The range and most likely value of each of the basic variable are given in table 6.3. Variable in rupees, you can see there are three sections: variable in rupees, range rupees, and most likely value. Given the range and most likely value of basic variable, we can study the impact of variation in each variable on net present value, holding other variable constant at time at their most likely levels. To illustrate the nature of this analysis, we shall look at the relationship between I, R and NPV and P and NPV. R and NPV, the relationship between R and NPV given the most likely value of other variable is NPV is equal to sigma phi tends to T is equal to 1. 160 160 7 750 minus 4 400 minus 1 lakh 20,000 minus 1 lakh 60,000. 1 minus 0.6 plus 160,000 upon 1 plus r t raised to 1 plus r raised to t plus 4 lakhs upon 1 plus r raised to 5 minus 1 lakh 20,000 is equal to sigma phi tends to t is equal to 1. Two seven two triple zero upon 1 plus r raised to t plus 400 triple zero upon 1 plus r raised to 5 minus 1 lakh 20,000. The net present value for various value of r is shown below. The same the net present value of various values of r is shown below. The same relationship is shown graphically in table 6.4. R is equal to NPV 8% rupees 158.0.880. 9%, 118.080, 10%, 79552, 11%, 42700. P and NPV. The relationship between P and NPV given the most likely value of the other factors is NPV is equal to sigma phi tends to T is equal to 1. You can see there's some figures out there, some numbers. The net present value of for various values P is shown below. The net present value for various values of P is shown below. The same relationship is shown graphically in table 6.4. Composite picture. The useful way of presenting the result of sensitivity analysis is to be shown how net present value behaves for different percentage of unfavorable changes from their most likely values in the basic variables. The basics, the behavior of net present value when there is 5%, 10%, 15%, and 20% unfavorable change in R. Other factors remaining unchanged at their most likely levels is shown as follows. Percentage unfavorable variation. Value of R net present value. The behavior of net present value when there is 5%, 10%, 50% and 20% unfavorable variation is P shown as follow. Percentage unfavorable variation value of P net present value 5, 10, 15, 20 point, point 730 point 575 point 638 point 600. What's the net present value? 10308 12 102 500 192 267 284 384. Exhibit 6.5 shows graphically the behavior of net present value for various unfavorable changes. Percentage variation of R and P, such as visual representation is helping in identifying variables which are crucial for the success of the project. Evaluation sensitivity analysis, a popular method for assessing risk, has certain merits. It forces management to identify the underlying variables and their interrelated relationship. It shows how robust or vulnerable a project is to change in the underlying variables. It indicates the need for further work if the net present value or internal rate of pattern is highly sensitive to changes in some variable. It is desirable to gather further information about that variation. Sensitivity analysis, however, suffers from several limitations. It may fail to provide a lead if sensitivity analysis merely present a complicated set of switching values in it may not shed light on the risk characteristic of the project. The study of the impact of variation is one factor at time, holding other factor constant may not be very meaningful when the underlying factors are likely to be interrelated. When sense does it make to consider the effect of variation in price while holding quantity, which is likely to be closely related to price unchanged. Scenario analysis. In sensitive analysis, typically one variable is varied at a time. If variables are interrelated, as they are most likely to be, it is helpful to look at some plausible scenarios. Each scenario representing a consistent combination of variables. Procedure. The steps involved in scenario analysis are as follows. Select the factor around which scenario will be built. The factor chosen must be largest source of uncertainty for the success of the project. It may be the state of economy or interest rate of technological development or response of the market costs. Calculate the net present value, net present and the or internal rate of return under each scenario. Estimate the values of the variables in investment analysis, investment outlay, revenues, cost, project life, and so on for each scenario. Illustration. Chain enterprises is evaluating a project for introducing a new product. Depending on the response of the market, the factor which is largest source of uncertainty for the success of project, the management of firm has identified three scenarios. Scenario 1, the product will have a moderate appeal to customers across the board at the modest price. Scenario 2, the product will strongly appeal to a large segment of the market which is highly price sensitive. Scenario 3, the project will appeal to a small segment of the market which will be willing to pay a high price. Initially, you can see the rupees in million. There is a figure. Initial investment. You need. There are three sections: scenario 1, scenario 2, scenario 3. Initial investment, underselling prices, demand in rupee in units, revenues, variable cost, fixed cost, depreciation, pre-tax profit, profit after tax, annual cash flow, project life, salvage value, net present value, at a discount rate of 50%. Welcome back. Now we will talk about the scenario analysis. In sensitivity analysis, typically one variable is varied at a at a time. At a time, if variables if variables are interrelated as they are most likely to be, it's, it's, it's useful to help to look at some plausible scenarios. Each scenario representing a consistent combination of variables. Consistent combination of variables. What is the procedure? The steps involved in scenario analysis are as follows. Select the factor around which scenario will be built. The factor chosen must be the larger source of uncertainty for the source or success of project. It may be the state of the economy or interest rate of technological development or research response of the market cost. Estimate the value of each of the variables in investment analysis. Investment outlay, revenues, cost, project life, and so on for each scenario. Calculate the net present value and or internal rate of return under each scenario. What is the illustration? Chain Enterprises is evaluating a project for introducing new product. Depending on the response of the market, the factor which is the largest source of procedure. The step involves in scenario analysis as follows. Select the factors around which scenario will be built. The factor chosen must be the largest source of uncertainty for the success of the project. It may be the state of the economy or interest rate of technological development or response of the market costs. Estimate the value of each of the variables in investment analysis. Investment outlay, revenues, cost, project life, and so on. For each scenario. 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 The third, calculate the net present value and or internal rate of return under each scenario. What is the illustration is that Zen Enterprise is evaluating a project for introducing a new product. Depending on the response of the market, the factor is the largest source of uncertainty for the success of the project. The management of the firm has identified three scenarios. Scenario 1. The product will have a moderate appeal to customers across the board at the modest price. Scenario 2. The product will strongly appeal to a large segment of the market which is highly price sensitive. Scenario 3. The product will appeal to a small segment of the market which will be willing to pay a high price. Now we will talk about the another one. Another one keyword point is that best and worst case analysis. In the above illustration, an attempt was made to develop a scenario in which the values of variable were internally consistent. For example, high selling price and low demand typically go hand in hand. Firms often do another kind of scenarios analysis called the best case and worst case analysis. In this kind of analysis the considered best scenario: high demand, high selling price, low variable cost, and so on. Normal scenario: average demand, average selling price, average variable cost, and so on. Worst scenario: low demand, low selling price, high variable cost, and so on. The objective of such scenario analysis is to get a free of what happens under the most favorable or the most adverse configuration of key variables, with bothering much about the internal consistency of such configurations. Evolution. Scenario analysis may be regarded as an improvement or sensitivity analysis because it considered variation in several variables together. However, scenario analysis has its own limitation. It's based on assumption that there are few well delineated scenarios. This may be not true in many cases. For example, the economy does not necessarily lie in three discrete states: with recession, stability, and boom. It can uh, it can in fact be anywhere on the continuum between the extremes. When a continuum is converted into three discrete states, some information is lost. Scenario analysis expands to concept of estimating the expected value. Thus, in a case where there are 10 inputs in analysis has to estimate 30 expected values 3 by 10 to do a scenario analysis. Break-even analysis. In sensitivity analysis, that we ask what will happen to the project if sales decline or cost increase or something else happens. As a finance manager, you will also be interested in knowing how much should be produced and sold at a minimum to ensure that the project does not lose money. Such an exercise is called break-even analysis, and the minimum quantity at which loss is avoided is called the break-even point. The break-even point may be defined in accounting terms or financial terms. Accounting break-even analysis. Suppose you are the finance manager of Naveen Flour Milk. You are finance manager of Naveen Flour Mills. Naveen is considering setting up a new flour mill near Bangalore. Based on Naveen's previous experience, the project staff of Naveen has developed a figure showing invest investment 0 year investment 20,000. Year 1 to 10 sales 18,000. Variable cost 66 plus percentage of sales 12,000. Fixed cost is 1000. Depreciation is 2000. Pre-tax profit is 3000. Taxes is 10,000. Profit after taxes is equal to 200. 2000. Cash flow from operation is 4000. Net cash flow 20,000. 4000. Note that the ratio of variable cost to sales is 0.667 12 by 18. This means that every rupee of sales makes a contribution of rupees double three. Put differently, the contribution margin ratio is 0.33, hence the break-even level of sales will be fixed cost plus depreciation upon contribution are in ratio 1 plus 2 upon 0.33 is equal to rupees 9 million. By way of confirmation, you can verify that the break-even level of sales is indeed in rupees 9 million. Sales rupees in million, sales 9. Variable cost 6, fixed deposit 1, depreciation 1, profit before tax 0, tax 0, profit after tax 0. A project Now we will talk about best and worst case analysis. In the above illustration, an attempt was made to develop scenario in which the values of variables were internally consistent. For example, high selling price and low demand typically go hand in hand. Firms often do another kind of scenario analysis called the best case and worst case analysis. In this kind of analysis, considered best scenario, high demand, high selling price, low variable cost, and so on. Normal scenario, average demand, average selling price, average variable cost, and so on. The objective of such scenarios available is to get free of what happens under the most favorable or the most adverse configuration of key variable without bothering much about the internal consistency of such configurations. Evolution scenario analysis may be regarded as an improvement or sensitivity analysis because it considered variation in several variables together. However, scenario analysis has its own limitation. It, it is based on the assumptions that there are few well delineated scenarios. This may not be true in many cases. For example, the economy does not necessarily lies in the three discrete states with recession, stability, and boom. Now we'll talk about the break-even analysis. In sensitivity analysis, we ask we that what will happen to the project if sales decline or cost increase or something else happens. As a finance manager, you will also be interested in knowing how much should be produced and sold at minimum to ensure that the project does not lose money. Such as exercise is called break-even analysis, and the minimum quantity at which loss is avoided is called the break-even point. The break-even point may be defined in accounting terms or financial terms. Accounting break-even analysis. Accounting break-even analysis. Suppose you are the finance manager of Naveen Flour Mills. A project that Breaks even in accounting terms is like a stock that gives you a return of 0%. In both cases, you get your original investment, back your original investment, but you are not compensated for the time value of money or the risk that you bear. Put differently, you forgo the opportunity cost of your capital. Hence, a project that merely breaks in even in accounting terms will have a negative NPV. Financial break-even analysis. Focus of financial break-even analysis is on NPV and not accounting profit. At what level of sales will the project have zero NPV? To illustrate how the finance break-even level of sales is calculated, let us go back to the flour mill project. The annual cash flow of the project depends on sales as follows. Variable cost 66.67% of sales. Contribution 33.33 of sales. Fixed cost rupees 1 million. Depreciation rupees 2 million. Pre-tax profit 0.33 cents rupees 3 million. Tax at 33.3% is 0.333. 0.333 cents rupees 3 million. Profit after tax 0.667. 0.33 cents rupees 3 billion. Cash flow 4 plus 7 rupees 2 million plus 0.067. 0.333 cents rupees 3 million is equal to 0.332 cents. Since the cash flow lasts for 10 years, it its present value at discount rate of 12% is PV cash flow is equal to 0.222 sales multiplied by PVI FA 10 years 12% is equal to 0.222 sales multiplied by 5.650 is equal to 1.255 cells. 1.255 cells. So now we will talk about the financial break-even analysis. The focus of break-even analysis is on NPV and not accounting profit. At what level of sales will will the project have a zero NPV? To illustrate how the financial break-even analysis level of sales is calculated, let us go back to the flour mill project. The annual cash flow of the project depend on sales as follow. Variable cost 67% of sales. Contribution 33.33 of sales. Fixed cost is 1 million rupees 1 million. Depreciation rupees 2 million. Pre-tax profit 0.333 sales 3 million. Since the cash flow lasts for 10 years, its present value a discount rate of 12% is PV cash flows 0.222 sales PVIFA 10 years 12% is equal to 0.333 sales multiplied by 5.650 is equal to 1.255 cells. The project breaks even in NPV terms when the present value of these cash flows equal the initial investment of rupees 20 million, as the financial break-even occurs when PV cash flows is equal to investment one point two double five sales is equal to 20 million rupees. 20 million sales is equal to rupees 15.94 million. Thus, the sales for the 4 floor mill must be rupees 15.94 million per year for the investment to have a zero NPV. Note that this is significantly higher than rupees 9 million, which represent the accounting break-even sales. Hillier model. Under certain circumstances, the expected net present value and the standard deviation of net present value may be obtained through analytic derivation. Two, chas- Two cases of such analysis are discussed here: no correlation among cash flows and perfect correlation among cash flows. Uncorrelated cash flows. When the cash flows of different years are uncorrelated, the cash flows for year T is independent in the independent of the cash flow for year IR. Put differently, there is no relationship between cash flows from one period to another. In this case, the expected net present value of the standard deviation of net present value are defined as follows. NPV. Sigma n tends to t is equal to 1. AI upon 1 plus I all raised to t minus 1 up to 8.2. Omega NPV is equal to sigma n tends to t is equal to 1 omega square omega t square upon 1 plus I whole raised to one plus I upon raised to t 2t up to 8 3, where NPV is expected net present value. AT is equal to expected cash flow for year T. I is equal to risk-free interest rate. T is equal to initial outlay. Omega NPV is equal to standard deviation of net present value. NPV is equal to expected net present value. AT is equal to expected cash flow for year T. I is equal to risk-free interest rate. T is equal to initial outlay. Omega NPV is equal to standard deviation of net present value. Omega 1 is equal to standard deviation of the cash flow year T for year T. Note that in the above formula, the discount rate is the risk-free interest rate because we try to separate the time value of money and the risk factor. This is the this is risk of project reflected in omega NPV is considered in conjunction with LPV compared with the risk-free discount rate. If omega NPV is computed using a risk-free, risk-adjusted adjust discount rate, then if this is viewing along with omega NPV, the risk factor would be doubled counted. Now we will talk about its example. A project involving an outlay of rupees 10,000 has the following benefits associated with it. Year 1, Year 2, Year 3. Net cash flow probability, net cash flow probability, net cash flow probability. Rupees 3,000, 5,000, 7,000. Rupees 0.3, 0.4, 0.36. For year 2, net cash flow is rupees 200, 400, 4,000, 2,000, 4,000, 6,000. Year 2 probability is rupees 0.2, 0.6, 0.2. For year 3, net cash flow is rupees 3,000, 5,000, 7,000. And probability is rupees 0.3, 0.4, 0.3. Calculate an omega NPV is assuming that I is equal to 6%. So I is equal to 5000 upon 1.06 upon 4000 upon 1.06 square plus 5000 upon 1.06 upon raised to 3 is equal to 10,000 is equal to 204,075 is equal to omega npv is equal to sigma n tends to t is equal to 1 omega t square upon 1 plus I upon 1 raised to 2t is equal to 24 lakhs upon 1.06 square plus 16 lakhs upon 1.064 1.06 raised to 4 plus 24 lakhs upon 1.06 raised to 6 is equal to rupees 2,258. Perfectly correlated cash flows. If cash flows are perfectly correlated, the behavior of cash flows in all periods is alike. This means that if the actual cash flow in the year is standard deviations to the left of its expected value, cash flows in, in other years will also be the standard deviation to left of their respective expected value. Put in other words, cash flow of all years are linearly related to one account to the to one account. This expected value and the standard deviation of the net present value when cash flows are perfectly correlated as are as follow. Adjust NPV is equal to up to 8 per 3. Omega NPV is equal to sigma n tends to t is equal to omega t upon 1 plus I raised to t. Example 2. An investment project involves a current outlay of rupees 10,000. The mean and standard deviation of cash flows, which are perfectly correlated, are as follows. Sigma n tends to t is equal to adjust at upon 1 plus I all raised to t minus 1. Here 1, 1, 2, 3 adjust t 5000, 3000, 4000, 3000 omega t 1500, 1000, 2000, 1200 calculate adjust NPV in omega NPV assuming a risk-free interest rate of 6%. Adjust NPV is equal to sigma 4 raised to t is equal to 1. A, adjust AI upon 1 plus I raised to t minus I is equal to 5000 upon 1 plus 0 6 4000 upon 1 plus 0 plus 6 square 5000 upon 1 plus 0 6 cube plus 3001 upon 1.06 raised to 4 is equal to 10,000 is equal to 3121. Omega NPV is equal to sigma 10 n tends to t is equal to 1. Alpha 1 minus adjust at upon IR t 1 plus I up raised to t minus 1 is equal to 1500 upon 1.06 plus 1000 upon 1.06 square plus 2000 upon 1.06 cube plus 1012 200 upon 1.064 S to 4 is equal to rupees 44935. Standardizing is the distribution. The knowledge of adjust NPV and omega NPV is very useful for evaluating the risk characteristics project of a project. If the NPV of a project is approximately normally distributed, we can calculate the probability of NPV being less than or more than certain specific value. Now, the project breaks even in NPV term when the present value of these cash flows equals to initial investment of 20 million. Hence, the financial break-even occurs. PV is equal to cash flows is equal to investment. 1.255 sales is equal to 20 million. Sales is equal to 15.94 million. Thus, a sales of the flour mill must be rupees 15.94 million per year for the investment to have zero NPV. Note that this is significantly higher than the rupees 9 million which represented accounting break-even sales. Hillier model. Now we will talk about another topic, Hillier model. Under certain circumstances, the expected net present value and the standard deviation of present value may be obtained through analytic derivation. Two cases of such analysis are discussed here. No correlation among cash flow and perfect correlation among cash flows. Uncorrelated cash flow. When the cash flow of different years are uncorrelated, the cash flow for year T independent of the cash flow for your IR. There is a no relationship between cash flow from the one period to another. In this case, the expected net present value and the standard deviation of net present value are defined as follow. Adjust NPV is equal to sigma n times 2 it is equal to 1. EI adjust upon 1 plus I raised to t all minus 1 up to 8.2. Sigma NPV is equal to sigma n times 2 t is equal to 1 omega t square plus 1 plus I raised to t 2t up to 8.3, where NPV is equal to expected net present value. Adjust AT is equal to expected cash flow for year T. I is equal to risk free interest rate. T is equal to initial outlay. Omega NPV is equal to standard deviation of the net present value. Omega T, omega 1 is standard deviation of the cash flow for year T. Note that in this above formula, the discount rate is risk-free interest rate because we try to separate the time value of money and risk factor. This risk factor of the project reflected in omega t omega NPV is considered in conjunction with NPV adjust NPV computed with the risk-free discount rate. If is computed using risk-adjusted discount rate and then this viewing along with sigma NPV, the risk factor would be doubled counted. Now we'll talk about the key point. Perfectly correlated cash flows. It if cash flows are perfectly correlated, the behavior of cash flows in all periods is alike. This means that if the actual cash flow in one year is a constant deviation to the left of its expected value, cash flows in other year will be also be a standard deviation to left of these their respective expected value. Put in other words, cash flow of the year all year are linearly related to one another. The expected value and the standard deviation of next present value, the cash flows are perfectly correlated as follows. Sigma is NPV adjusted NPV is equal to up to 8.3. Omega NPV is equal to sigma sigma n tends to t is equal to 1 sigma t omega t upon 1 plus I raised to t. First example is that an invest now we have an example here. An investment project involves a current outlay of rupees 10,000. The mean and standard deviation of cash flow which are perfectly correlated as are follow. You can see the year adjusted T and sigma omega T. For year 1, omega adjusted T is equal to 5,000 and omega T is equal to 5. Omega T is 1500. For year 2, adjusted T is 3000 and omega T is 1000. For year 3, adjusted T is 4000, omega T is 2000. For year 4, adjusted T is 3000 and omega T is 12,000. Voilà. 100 to 200, 1,200, 200. How can we calculate the area to left or right of the specified point? To calculate the area to the different or right of a specified point, we use the following procedure. Welcome back. Now we'll talk about the simulation analysis. Sensitivity analysis indicates the sensitivity of the criterion of merit, NPV, IRR, or any other to variations in basis factor to provide information of the following type. If the quantity produced and sold decreased by 1%, other things being equal, the NPV falls by 6%. Such information, though useful, may be may not be adequate for decision making. The decision maker would also like to know the likelihood of such occurrences. This information can be generated by simulation analysis, which may be used for developing the probability profile for a criterion of merit by randomly combining value of variables which have a bearing on a chosen criteria. Procedure. The steps involved in stimulus analysis are as follows. There are 6 steps. First one is model the project. The model of the project shows how the net present value is related to the parameter and the exogenous variable. Parameters are input variable specified by the decision maker and held constant over simulation runs. Exogenous variables aren't input variables which are stochastic in nature and outside of the control of the decision maker. Specifies Specify the value of parameter and the probability distribution of the exogenous variables. Select a value at random from the probability distribution of each of the exogenous. Uh, Determine the net present exogenous variable and pre-specified parameter value. Repeat step 3 and 4 a number of times to get a larger number of simulated net present value. 6. Plot the frequency distribution of the net present value. Illustration. In real life situation, stimulation is done only on the computer because of the computational medium involved. However, to give you a flavor of what goes on in simulation, we will work with a simple example where simulation has been done manually. Zenith Chemicals is evaluating an investment project whose net present value has been modeled as follows. NP is equal to sigma n tends to t is equal to 1. Annual cost flow upon plus risk minus free rate minus initial investment. In the NPV model embodied in equation 8.5, the risk-free rate and the initial investment are parameters with the following values. Risk-free rate is equal to 10% and initial investment is equal to rupees 13,000. The annual cash flow and the life in are stochastic exogenous variables with the following distribution. Annual cash flow and project life. Value rupees, probability value, probability. The firm wants to perform 10 manual simulation runs for this project. To perform the simulation runs, we have to generate values at random for the two exogenous variables, annual cash flow and project life. For this purpose, we have to first to set up the corresponds between the value of exogenous variable and random numbers, and to choose some random number and generating device. Choose some random number generating device. Exhibit 8.10 shows the corresponds between various variable and two-digit random numbers. Exhibit 8.11 presents a table random digit that will be used for obtaining two digits of random numbers. Now we are ready for simulation. In order to obtain random numbers from exhibit 8.11, we may begin anywhere at random in the table and read any pair of adjacent columns. since we are interested in two-digit random number and read column wise or row wise. For example, let us use the first two columns of exhibit 8.11 starting 8.11 starting from the top. We will read down the column. Starting from the top, we will read down the column. For the first simulation run, we need two-digit random number. One for the annual cash flow and the other for the project life. These numbers are 53 and 97 and the corresponding value for annual cash flow and project life is are rupees 3000 and 9 years respectively. We go further in this manner. Table 6.11 shows the random numbers obtained as result of simulation. There are two sections. Annual cash flow and project life. Where there are four semi-sections: value, probability, cumulative probability, two-digit randomly number. Evaluation, an increasingly popular tool for risk analysis simulation, offers certain advantages. Its principal strength lies in its versatility. It can handle problem characterized by numerous exogenous variables following any kind of distribution in complex interrelationships among parameter, exogenous variable and endogenous variable. Such problems often defy the capability of analytic method. An increasingly popular tool of risk It compels the decision maker to explicitly consider the to interdependency and uncertainties characterizing the project. Simulation, however, a controversial tool, is suffers from several shortcomings. It's difficult to model the project and specify the probability distribution of exogenous variables. Simulation is inherently imprecise. It provides a rough approximation of the probability distribution of net present value or any other criterion of merit. Due to its imprecision, the simulated probability distribution may be misleading when a tail of the distribution is critical. A realistic simulation model, likely to be complex, would most probably be constructed by management scientists, not a decision maker. A decision maker lacking understanding of the model may not use it. To determine the net present value in simulation run, the risk-free discount rate is used. This is done to avoid prejudging risk, which is supposed to be reflected in dispersion of the distribution of net present value. Thus, the measure of net present value takes a meaning very different from its usual one that is difficult to interpret. Now we will talk about another analysis topic, decision tree analysis. The scientists Yet Vaignanik have come up with an electric moped. The firm is ready for pilot production, which is estimated to cost rupees 8 billion in take 1 year. If the results of pilot production are encouraging, the next step would be to test market the product. This will cost rupees 3 million and take 2 months. Based on the outcome of the test marketing, a manufacturing decision may be taken. The firm may, however, skip the test marketing phase and take a decision whether it should manufacture the product or not. If the firm decides to manufacture a product commercially, it is confronted with two options: a small plant or a large plant. This decision hinged mainly on the size of the market. While the level of demand in the short run may be guessed by result of test market, the demand in the long run would depend on how satisfied the initial users are. If the farmer builds a large plant initially, it can cater to the need of the market when demand growth is favorable. However, if the demand turns out to be weak, the plant would operate at a low level of capacity utilization. If the firm builds a small plant to begin with, its need not worry about a weak market and a consequent low level of capacity utilization. However, if the market turns out to be strong, it will have to build another plant soon, and thereby incurs a high higher total outlay. In order to save it from the competitive environment. To analyze situation of this kind when where sequential decision making in the face of risk is involved. Decision tree analysis use useful tool. This section discusses the technique of decision tree analysis. Now we'll talk about the steps in decision tree analysis. The key steps in decision tree analysis are identifying the problems and alternatives, delineating the decision tree, specifying probabilities and monetary outcomes. Fourth one is evaluating various decision alternatives. Now we'll talk about another first one, identifying the problems and alternatives. To understand the problem and develop alternatives, information from different sources, marketing research, engineering studies, economical forecasting, financial analysis, etc. has to be tapped. Imaginative effort must be made to identify the nature of alternatives that may arise as the decision situation unfolds itself and assess and, and assess the kind of uncertainty that lie ahead with respect to market share, price, cost structure, availability of raw material and power, competitive action, governmental regulation and technological change and power technological changes. Recognizing recognizing that risk and also uncertainty are inherent characteristics of investment projects. Person involved in analyzing the situation must be encouraged to express freely their doubts, uncertainties, and reservations, and motivated to suggest a contingency plan and identify promising opportunity in the emerging environment. Now we talk about specifies probability and monetary value of outcome. Specifying probability and monetary outcome. Once the decision tree is delineated, the following data have to be gathered. Probabilities associated with each of the possible outcomes at various chance forks. Monetary value of each combination of decision alternative and chance outcome. The probability of various outcomes may sometimes be defined objectively. For example, the probability of a good monsoon may be may be based on objective historical data. More often, however, the possible outcomes encountered in real life are such that objective probability for that them cannot be obtained. How can you, for example, define objectively the probability that a new product like a electric moped will be successful in the market? In such cases, probabilities have to be probability have to be necessary defined subjectively. This does not, however, mean that they are drawn from a hat. To be useful, they have to be based on the experience, judgment, intuition, and understanding of informed and knowledgeable ex- executives. Assessing the cash flows associated with various possible outcomes to is difficult task. Again, the judgment of experts play an important role. So now we will talk about the another one, third one, delineating the decision tree. The decision tree exhibiting the anatomy of the decision situation shows the chances, the chance point are called chance fork, where outcomes are dependent on a chance process and the likely outcome at these points. The decision points, also called decision forks, and the alternative option available for experimentation and action at these decision points. The decision tree reflect in the diagrammatic form the nature of the decision situation in terms of alternative courses of action and chance outcome which have been identified in the first step of the analysis. A decision tree can easily become very complex and cumbersome if an attempt is made to consider the myriad possible future events and decisions. Such a decision tree, however, is not likely to be a very useful tool for analysis of analysis or elaborate. It may uh, obfuscate the critical issues. Hence, an effort should be made to keep the decision tree somewhat simply so that the decision makers can focus their attention on major future alternatives without being drowned in a mass drive. One must remember the advice of Bradley and Myers. Decision trees are like grapevines. grapevines. They are productive only if vigorously pruned. pruned. Evaluating the alternatives. Once the decision tree is delineated and data about probability and monetary values gathered, decision alternative may be evaluated as follows. Start at the right hand end of tree and calculate the expected monetary value at various client points that come first as we proceed leftward. Given the expected monetary value of sans point in step 1, evaluate the alternatives at the final stage decision points in terms of their expected monetary value, and each of the final stage decision points select the alternative which has the highest expected monetary value and truncate the other alternative. Each decision point is assigned a value equal to the expected monetary value of the alternative selected at the decision point. At that decision point, proceed backward, leftward in the same manner, calculating the expected monetary value at chance point. Selecting the decision alternative which has the highest expected monetary value at various decision points. Truncating into inferior decision alternatives and assigning value to decision point till the first decision point is reached. What the illustration is that the technique of decision tree analysis may be explained with the help of an illustration. A wildcatter evaluating a particular basin is considering three alternatives. He may drill, he may conduct a seismic experiment, costing rupees 20,000 rupees 20,000 to find the nature of the underlying soil structure and decide on the basis on that basis. He may not do anything. He may not do anything if he drills. He is likely to find one of the following oil-bearing status: dry, wet, or soaking. A dry, wet hardly yields anything. A wet well provides a moderate quantity of oil. A soaking well generates a substantial quantity of oil. If he conducts a seismic experiment, he can learn about the underlying soil structure before deciding whether to drill or not. The underlying soil structure in this case may be one of the following types: no structure, open structure, or closed structure. If no structure is discovered, the prospect of finding oil are bleak. If open structure is found, the prospect of finding oil are fair, and if closed structure is discovered, the prospect of finding oil are bright. The decision tree corresponding to this situation is shown in Exhibit 6.13. It may be noted that convention or decision fork is represented by a square and sans fork by a circle. A decision tree declared delicate delineated. The next phase of analysis calls for gathering information about probabilities and monetary value associated with various outcomes in the decision tree. The validator reviews his experiences, analysis statistics relating to oil discoveries, and consults geological expert. He comes up with the following information. Probability for various oil bearing states. If we drill without conducting seismic experiments, probability for various oil bearing states are oil bearing rate and other side is probability. If oil bearing rate is state is dry, then probability is 0.50. If it's wet, then it will be 0.25. If it's soaking, then it will be 0.25 as it is. Probabilities for various soil structures. If we conduct a seismic experiment, he is likely to find underlying geological structures with probabilities mentioned against them. Geological structure and probability. No structure NS 0.40. Open structure OS 0.30. Closed structure CS 0.30. Relationship between the underlying structure and oil bearing states. The relationship between the underlying geological structure and oil-bearing state expressed in terms of joint possibilities is as follow. Underlying geological structure, oil-bearing state, no structure, open structure, closed structure, marginal probability of state. Oil-bearing state is dry, wet, marginal probability of geological structure. Here is the figure, and it shows this type of, you can see there, you can see the first section is the D1 main section. It partition in three way, D1 to in that you can do nothing. For D1 to conduct seismic, and third one is also C1. C1 having the four three section, C11, C12, C13. C11 for dry, C12 for wet, and C13 for soaking. So from D1, the middle one is the D1 to conduct seismic is going to C2. So C2 has three ways: no structure, closed structure, and open structure. Now we will talk about the node structure. Node structure divided into two ways. It could do drill and do not drill. Do drill section is C12 and do not drill section is uh, C21 C22. Now drill C21 drill section is partition in so D3 section is open into two ways. We already talked, so it will be C4. C4 having three sections, C41, C42, C43. C41 for dry, C42 for wet, and C43 for soaking. You can see we will talk about the now closed structure. It's a D4. It partition in two ways, drill and do not drill. C41 for drill, C42 for do not drill. As also C41 drill section having the C5 section, that C5 section having the three ways as another we can already we talk about C51, C52, C53. C51 for dry, C50, C52 for wet, and C53 for soaking. Monetary values of outcomes. The net present value of cash flows calculated at 12% discount rate associated with the three state for 5 years, which is the maximum duration of oil drilling, is given below. State and we can see another side is the net present value rupees in million. For dry it will be 0 minus 0.66 0.6. For wet it will be 0.8, and for shocking it will be 2.4. Exhibit 6.15 shows the exhibit 6.15 shows the decision tree incorporating information regarding probabilities and monetary value of outcome discussed above. With this decision tree, we evaluate the alternative courses of action as follow. There are how many sections? We can see the D1 section, the partition into three ways. We already talk about this one, so now we will this time we will neglect or ignore this one, and we will focus on the theory, right? Starting at the right hand and end of the tree, the expected monetary values EMVS at chances for C1, C3, C4 and C5. Which comes first when we proceed leftward are determined. EVM, EVM C1 is equal to rupees 0.5 million. EVM C3 is equal to rupees 0.16 million. EVM C4 is equal to rupees 0.367 million. EVM C5 is equal to rupees 1.513 million. Starting at right hand, given the expected second thing is given the expected monetary values, the alternatives at the last stage decision points in their expected monetary values are defined as follow. Decision point D2, D3, D4. Alternatives in rupees in million. D21 drill, D double true do not drill, D34 driven drill, D32 do not drill, D41 drill, D42 do not drill. Expected monetary value minus 0.16, 0.367, 0.05513. On the basis of the above information, the alternative selected at the decision point D2, D3, D4 and D2. D2 do not drill. D D4 and D2 do not drill. D31 drill and D41 drill respectively. The values assigned to the decision points D2, D31, D4 are 0 rupees 0.367 million and 0. And rupees 1.5513 million respectively. Proceeding leftward, the expected monetary value at chance fork C2 is calculated. Expected monetary value at C2 is equal to 0.4 multiply by 3b plus 0.3 multiply by 3.67 plus 0.3 plus 15.13 is equal to 0.564. Moving leftward, the first decision point is reached. The alternatives and their expected monetary value at this decision points are: alternative D11 drill, D12 conduct seismic experiments, D12, D13 do not do nothing. So what is expected monetary value rupees in million is that 0.5 for D12, D11, for D double or for alternative D11 drill it will be 0.5 expected monetary value, right? For D2 conduct a seismic experiment, the expected monetary value will be 0.544. For alternative D13 do nothing, the expected monetary value rupees in million is 0. Looking at the expected monetary value as find that even to conduct a seismic experiment is the most desirable alternative at the first stage of decision point. Figure 6.16 shows the decision with tree with expected value at chance point and decision points. Based on the above evolution of alternative, we find that optimal decision strategy is as follows. Choose D1 to conduct a seismic experiment. At decision point D1 and wait for the outcome at chance point C2. If the outcome at C2 is C21, no structure, then choose C22, do not drill. If the outcome at C2 is C22, open structure, then choose D31. If the outcome at C2 is C23, close the structure, then choose D for one drill. See, this is a structure. D1 findable for structure. It's a following the above decision strategy. The decision maker may, depending on the outcome at chance point, uh, traverse paths as shown in Figure 6.17. Path, probability, net and net present value. D1 to C1, C21 to D22. Probability 0.14 and net present value is minus 12, 20,000. For D1 to C1, C22 to D31 to D41. The probability is 0.15 and net present. And the net present value is it will be minus 0. Minus 6,20,000. For D1 to C22, D31 and D4242. The probability is 0.10. Net present value is 7,80,000. For path D12 to C22 to D31 to D43. The probability is 0.05 and the net present value is 23 lakhs 80,000. For path D1 to C2 to 3 D41 to D51. The probability is 0.03 and the net present value will be minus 6,20,000. For path D1 to C23 D41 to D52, the probability will be 0.811, 0.11, and the net present value will be minus 7,80,000. For path D12 to C23 to D41 to D53, the probability will be 0.16. The net present value is 23 lakhs 80,000. Evaluation. Decision trees are useful for analyzing a project that has a characteristics. Decisions on continuing the project are made in well-defined stages. The outcomes at each stage fall into a few broad classes. The probability is the probabilities and the cash flows associated with various outcomes can be specified at the beginning of the project. This means that the firm has experience of doing similar projects in the past. Obviously, decision tree analysis requires enormous information before it can be applied. The oil drilling project is one case where the required information may be available. However, it may be much more difficult to apply decision tree and analysis to to a project where the product or service is new and the firm has very little information on how the market will respond to to it. Decision trees are not easy to when investments are gradually made over a period of time rather than in few well-defined stages. Corporate risk analysis. A project corporate risk it is its contribution to the overall risk of the firm. Put differently, it reflects the impact of the project on the risk profile. Now we'll talk about the corporate risk analysis. Corporate risk analysis. A project's corporate risk is its contribution to the overall risk of the firm. Put differently, it reflects the impact of the project on the risk profile of the firm's total cash flows. We know that the contribution of the security to portfolio risk depend, depends on the standard deviation of its return and the correlation of its return with the return on the other securities included in the portfolio. In the same way, the corporate risk of a project depends on the standard deviation of its return and the correlation of its return with the returns on the other project of the firm. On a standalone basis, a project may be very risky, but if its returns are not highly correlated or better, negatively correlated with the return on the other project of the firm, its its corporate risk tends to be low. Aware of the benefits of portfolio diversification, many firms consciously pursue a strate- strategy of diversification. Hindustan Liver Limited, for example, has a diversified portfolio com- comprising in the main the following businesses: soaps and detergent, personal care product, edible oil and tea. The proponents of diversification argue that if it reducing the firm's overall risk exposure, as most businesses are characterized by cyclicity, it seems desirable that there are at least two to three different line of business in the firm's portfolio. As someone put it vividly, if you have 3 lakhs to your firm, you enjoy a reasonable degree of stability. This is simply another way of saying that don't pull all your eggs in the same basket. The logic of corporate diversification of reducing risk, however, has been questioned. Why should a firm diversify when shareholders can reduce risk through personal diversification? All that they have to do is to hold a diversified portfolio of security or participate in a mutual fund scheme. Indeed, they can do it for more efficiently. There does not seem to be an easy answer. Although shareholders can reduce risk through personal diversification, there are some other benefits from corporate diversification. Stable earning and cash flows enable a firm to attract talent, to secure greater commitment from various stakeholders, to exploit tax shelters fully, and to check adverse managerial incentivizers. Hence, most firms do not look at the impact of investment proposals, particularly the major one on the overall risk profile of the firm. Project selection under risk. Once information about expected return, measures as net present value or internal rate of return or some other criterion of merit and variability of return measured in terms of range or standard deviation or some other risk index has been gathered. The next question is, should the project be accepted or rejected? There are several ways of incorporating risk in the decision process. Segmental evaluation, payback period requirement, risk profile method, certainly equivalent method, and risk adjusted discount rate method. Judgmental evaluation. Often managers look at risk and return characteristic of a project and decide judgmentally whether the project should be accepted or rejected. Without using any formal method for without using any method for any formal method for incorporating risk in the decision making process. The decision may be based on the collective view of some groups like the capital budgeting committee on the executive or the executive committee. or the board of directors. His judgmental decision making appears highly subjective or haphazard. Consider how most of us make important decisions in our personal life. We rarely use formal selection method or quantity-wise techniques for choosing a career for a spouse or an employer. Instead, we rely on our judgment. Payback period requirement. In many situations, companies use NPV or IRR as the principal selection criterion, but apply a payback period requirement to control of a risk. Typically, if an investment is considered more risky, a shorter payback is required even if the NPV is positive or IRR exists the hurdle rate. This approach assumes that risk is the function of time. Ordinarily, it is true that the further a benefit lies in future, the more uncertain it is likely to be because economical and competitive condition tends to change over time. However, risk is influenced by things other than the mere passage of time, and the playback period requirement may not be an adequate method for risk adjustment or control. Now we will talk about the risk profile method. What? Risk profile method. To use this method, we first transfer the probability distribution of net present value to absolute measure into the probability distribution of probability index, a relative measure. To illustrate this transformation, let us consider that the probability distribution of the net present value of the project, which involves an investment outlays of rupees 1 lakh, shown in Exhibit 6.17. Since probability index is a linear transformation of net present value, the shape of its probability distribution is identical to that the probability distribution of net present value. The probability distribution of probability index for our project is shown in exhibit 6.18. It should be noted that the x-axis of this exhibit shows the probability index values corresponding to the net present values shown on the axis of exhibit 6.18. There are two, we can see this graph, and you can see the x-axis is net present value and probability is on the y-axis. When you start from zero, it highest it go up, it goes up and up, and it will be highest at the 20,000, and it 40,000, for 40,000 it will be the same as zero. The second one is the probability and probability index. Having